take it away.
Okay, so hello everybody. It's a great pleasure to introduce this session, and it has 4 very interesting papers on connected topics, but all slightly different. So let me give a very broad background. So anytime we mention contracts, we think that it would be nice to have verifiable records, and that is exactly what blockchain enables to do. So we can have records which enable to create common histories that everybody can agree. And then via the most initial and famous application of it that became widespreadly known, we obviously have Bitcoin, which where we only want to solve the problem of double spend. So it's obvious that it's a useful record keeping tool for all sorts of other data, like related to shipping and so on. And there are many initiatives like that. But what is relevant for this session is that whenever we have digital records and data, we can also build contracts on it. And especially the feature of smart contracts is that these are deterministic and programmable rules, which itself can be recorded on the blockchain. So all the applications considered in this session are taking this approach. And another way to think about it is that currently there is obviously the standard physical globes that we are all living on, but there is an increasingly equivalent, perhaps not so big yet, digital world or ecosystem, which has its own currencies, its own markets, its own pricing rules and valuation methods. And the papers in this session are tackling these sort of issues. And if you think of even of the example of Ethereum, for example, it maybe is a parallel in the real world of being oil or like a software which allows you to build things, but it is equally well functioning as money, which is not something that we have a parallel. So what these papers are doing in this session, they are making they're analyzing specific issues in the digital world with parallels to the real world and sometimes interaction with the physical world. Okay? And they all tackle the nuanced aspects which are already existing and are noticeably popular. And I'm sure the speakers will tell the information about the volume of these particular applications of blockchain and smart contracts functionalities. Not everything works perfectly, and that's exactly what makes these papers interesting. So we'll have their interesting empirical findings as well as theoretical insights. So a few words to say about topics. The first paper will look at MakerDAO's DAI token, which is a stable coin, but it's also a means for collateralized lending. And as a paper will further analyze by focusing less on the lending aspect, but more on the maintaining the stable coin, which needs to be done voluntarily by participants because it's not comparable to the real world's currency peg, for example. And at the same time, as it was also shown in the previous session, it is a tool for leveraging one's bets on the Ethereum token. The second paper looks at another topic, which is non-fungible tokens, which is definitely extremely fascinating. As the title also says, it's infinite but rare. So there is digital art, which on one can be copied as many times as you want as an art piece, but at the same time, it comes with a stamp of authority. It's kind of unclear how this asset should be valued, and this paper exactly looks at that. And of course, we know that there is famous cases with NFTs, like the Christie's, about 70 million NFTs that was auctioned, as well as even 5 pixel little things where you wonder why people are spending gas on it. But the paper has found a nice approach by using crypto kittens, which gives a very comparable data set. The last 2 papers were looking at the constant product, the automated market making, where effectively there are these decentralized exchanges where we are aiming to replace market maker and the limit of the books with some automated rule, which has some nice features, but also problems, as it will be shown by the paper by Andreas Bach, and then further analyzed in the paper by Jun Naoji and Yuki Ito in terms of letting investors to choose between this market making method versus using a limit order book. So I'm gonna stop the introduction here and give the floor to Ganesh Vishwanath Natrai, who's gonna present about centralized stablecoins and collateral.
Cool. Thank you, Catherine, for the introduction and for the organizers for inviting us. And this is joint work with Raman, who's also at Warwick Business School. So as you know, DAI is a stable coin, and it's typically backed by Ethereum collateral through smart contracts. The DAI peg is managed by the MakerDAO governance. And the idea is that it's a community which effectively has a system of stability tools to maintain the peg. And I'll discuss some of these stability tools shortly. And the idea of this paper is to think about what drives stability of the DAI peg. So there are two motivating facts behind this paper. The first is that the DAI peg is very correlated with Ethereum. So when we look at intraday measures of DAI volatility and ETH volatility, we see a strong correlation. The second fact that we want to explain is the co-movement between the DAI peg and ETH collateral. So here is an example of the so-called Black Thursday crypto crash in 2020. So in this event, DAI traded at a premium of almost 8 cents. So that's like an 800 basis point premium. And this was a day in which Ethereum collapsed by 50%. So there is this negative co-movement between DAI prices and ETH collateral, and that's something we want to explain in this paper. So these are the empirical observations that DAI tends to trade at a premium when ETH returns are negative. DAI prices are more volatile when ETH collateral is more risky. The third observation, which is the so-called solution, is the introduction of stable collateral. And since MakerDAO introduced stable collateral, the peg has become much more stable. And the reasoning behind this is that risky collateral acts as a limit to arbitrage. So if you have DAI that's borrowed from depositing Ethereum collateral, there's no real arbitrage to close peg deviations because the ETH collateral is very volatile. But if you have a stable collateral, then that enables you to make arbitrage if peg deviations are large. So that essentially is thinking about how to increase peg efficiency. That's the solution that we put forward, is to have stable collateral. Okay, so obviously I don't have a lot of time, but we have a model where we go through some of these sort of intuition behind the difference between risky versus stable collateral. And we also try to think about mechanisms that would account for negative co-movement between DAI prices and ETH collateral. And for empirical evidence, we have some data on individual CDPs. So we can actually look at how they're responding to ETH returns and volatility. We then look at the fundamentals of peg deviations and then the introduction of stable collateral types. Okay, so many of you will know how DAI works. So just as a brief summary, every DAI is generated by depositing collateral assets into Maker vaults. Users can then use DAI either on exchanges like Uniswap or other DeFi applications. As a stylized example, on the left, we have an investor that has 1 Ethereum. They then deposit into a CDP. they can then borrow a fraction of that Ethereum collateral as DAI tokens. And on the right side, we have the investor closing their position. So once they have kind of, done their investment and they want to close, they redeem their DAI tokens, they withdraw their ETH collateral, and then they can close their position. So one important thing is that they effectively have a haircut, so you can't borrow the full value of your collateral. You can only borrow a fraction of it. So this fraction is to prevent liquidation events. So typically for Ethereum collateral, you can borrow a maximum of 2/3 of your Ethereum collateral. And if your borrowings exceed that, then the position is liquidated, where an investor is required to repay the debt through their remaining collateral and also pay a liquidation penalty that's up to 15%. So the MakerDAO governance have a set of stability tools, and this includes stability rates, which are effectively like a rate on DAI borrowings, and they are set through the Maker token. So investors can stake governance tokens to vote on the stability rate, for example. They can also vote on the addition of collateral types. So there are two events here. In March 2020, they decided to adopt another stablecoin as collateral. And in December, they went one step further, where they introduced this peg stability module, which is a swap arrangement between DAI and USDC. So it's very similar to having USDC as stable collateral. The difference is an investor doesn't need to deposit USDC collateral anymore. They can just swap USDC for DAI at a 1-for-1 rate with the governance. So these are just some descriptives. So on the panel A, we have the DAI price. So as you can see, there's a lot of volatility in DAI prices, but we then note that it becomes much more stable since December 2020. And the leverage ratio, the red line in panel C is 66%, which is the 2/3 limit, but we find that the leverage ratio is in fact much lower. So typically investors maintain a much lower leverage to avoid liquidation events. And panel D is just the interest rates that are set by the Maker protocol. Okay, so the model is trying to bring some economic intuition behind some of the results that I showcased at the beginning. So the DAI peg is more volatile when ETH collateral is more volatile, and we also want to show this negative co-movement between DAI prices and ETH collateral. So here we have a simple model where we've got investors that deposit Ethereum collateral and borrow DAI. And in period 1, arbitrageurs take the long position. Then period 2, we have a DAI demand shock. And depending on the state of Ethereum collateral, we can get either discounts or premiums. So this is where we can think about why, for example, there are DAI premiums when ETH collateral crashes. So the agents are speculators. So they're the ones who are depositing Ethereum collateral and borrowing DAI tokens. Arbitrageurs are the ones that are stepping in when there's any price discrepancy. And so here, this is where unstable collateral acts as a limit to arbitrage, right? So if they are using Ethereum as collateral in their arbitrage trade, that's very risky. And so they will need higher premiums as compensation. The demand side, we just fix as exogenous. So these are the laws of motion for the wealth of speculators, arbitrageurs, where they follow standard mean variance functions. And arbitrageurs have different laws of motion for wealth, depending on whether they take a long or short position. So these are market clearing conditions in both periods, where the difference is in period 2, we have this extra demand component. So we want to think about two states of Ethereum. So we have Ethereum that's either in a good state where Ethereum returns are high, or Ethereum in a bad state where Ethereum returns are low. So when Ethereum is volatile, so if we look at panel B, we find that in the high volatility bad state, our model generates a premium. And this matches that stylized fact that during the Black Thursday crash, we found DAI premiums when Ethereum crashed. And so this is the idea that in the bad state, investors deleverage, right? So investors are now pessimistic about Ethereum. They deleverage and they borrow less DAI tokens. So given there's some demand for DAI in the secondary market, arbitrageurs have to step in to supply DAI, but they will only incentivize to do so if they can earn a premium when they sell DAI in the secondary market. So that's why we get big premiums in the bad state. So these are some additional comparative statics. So the middle panel is effectively reproducing the first fact, where when the Ethereum volatility is high, we get a higher volatility of the peg. So our model can generate that fact. We also look at comparative statics with respect to the stability rate. And our last part of the model is thinking about adding stable collateral. So here we give arbitrageurs an extra option where they can now use USDC as collateral, which has a lower volatility. And this is important because now when they have to supply DAI in the secondary market, they are able to do so at lower premiums, right? Because they are now able to supply DAI by depositing USDC collateral, which is much less risky. So they can absorb DAI demand much easier with smaller premiums. And this is comparative statics with respect to volatility of the USDC collateral. So here, when the USDC volatility is higher, DAI volatility is higher. And we also note that the share of USDC collateral used by arbitrageurs increases when USDC volatility is low, right? So arbitrageurs naturally will use this as a collateral type when its volatility is low relative to ETH. So there are three types of empirical evidence. The first is using individual CDP data. And the idea is to think about, we have a panel of CDPs where the outcome variables are the amount of DAI borrowing, the amount of ETH collateral, the leverage, and a dummy variable indicating a liquidation event. And we want to see how they respond to ETH returns and volatility. And we find that the DAI borrowings are very positively associated with ETH returns, which is intuitive that investors will supply more DAI in the market when ETH returns are strong. They will also deposit more ETH collateral. So again, that matches our prediction that in good states of the world, investors will deposit more ETH collateral and borrow more DAI. The ratio, which is the leverage, will actually decrease. And the bite or liquidation event in the last column, that is negatively associated with ETH returns. So when ETH returns crash, that's when we expect liquidations of these positions. We then look at the negative co-movement between DAI prices and ETH returns. And this matches the second fact where we think about when ETH collateral crash, do we get DAI premiums? And that's what we find. So we find that there is a significant negative correlation between DAI premiums, which is delta, and the return on Ethereum collateral. And we find that this premium is really explained by periods of negative returns. So this R minus ETH is kind of capturing negative ETH returns, and that's when we find we get our negative correlation. So we also find in the last columns, we find a positive relationship between ETH volatility and DAI volatility. So that's the collateral risk plot that I showed earlier, but in a sort of regression. And the last piece of empirical evidence is thinking about...
You have about 1 minute.
Okay, thanks. So the last empirical evidence is the safe collateral type introduction. So we note that since December 2020, the DAI peg has become much more stable. And this has coincided with the use of USDC. In particular, the swap arrangement where users can swap DAI with USDC at a 1-for-1 rate. So we do a different diff setup where we use the peg stability module in December 2020 as our post. And we find that DAI USD deviations became much smaller relative to USDC USD deviations following this event. So in line with our peg efficiency hypothesis. Okay, so through a model, we explained the relationship between DAI peg volatility and ETH volatility and the negative co-movement between DAI prices and ETH returns. And we also showed that through empirical evidence, and that safe collateral leads to an increase in stability of the peg. And there's some interesting implications, like what would happen if you were to have a digital dollar on the blockchain? Would that become the dominant collateral? So there's some interesting thoughts about, what could happen in the future if there is a digital dollar. But yeah, thank you.
Thank you. And I guess that it's better to move on with the presentations and see if there is time with questions and so. So next talk is by Pavel Kireyev about infinite but rare about non-fungible tokens.
Okay, hello everyone. Can you see my screen and hear me well? Everything is working?
All good.
Okay, and I should go on for, I guess, 15 minutes until 55-ish. Okay. Well, thank you everyone for joining this talk. This is a talk about non-fungible tokens. And as I'm sure you're aware, over the past year, NFTs have really exploded massively in popularity. These are two examples of high-profile NFT sales. On the left-hand side, I have a sale for an artwork by Artist People that sold for almost $70 million at Christie's auction house. And on the right side, I have a CryptoPunk that sold for almost $12 million by the competitor Sotheby's auction house. And the total transaction volume of NFTs is on the order of $13 billion, $14 billion by now. So the market is really growing at an incredible pace. I often tell myself that when I started writing this paper a year and a half ago, I should have just purchased a CryptoPunk. But instead, I studied the market and wrote a paper about it. So I don't have a CryptoPunk that at that time was worth about $1,000 and now is maybe selling for millions of dollars. But at least we have this research paper, which is hopefully it's worth something, I hope. Okay, so what are NFTs? I'm sure that people here are more or less aware of NFTs, but I'll just give a description of how I view them. We can look at these two images. So these are both JPEG or PNG or some kind of an image file of a CryptoKitty, which is a popular NFT collectible series. On the left-hand side, we have the scenario with no blockchain. So people have been selling images before. And typically what would happen is that the sale of, let's say, an image, a stock photo would be logged in a database. There would be legal enforcement if somebody tried to use this image in ways they weren't supposed to use it. But the system, of course, does not function very well because it is just so easy to download and share an image anywhere and very hard to track it. On the right-hand side, we have sort of the blockchain-based scenario where the creation of the asset, its ownership transfers are logged in a distributed ledger. This CryptoKitty, for example, could have ID number 103 assigned to it, which means it was the 103rd one created. And smart contracts can actually specify some of the constraints around the production of these assets, their creation, and so on. So I view NFTs as a digital certificate of ownership for a otherwise easily shareable and infinite file. And in this case, I'll be focusing mostly on image-based NFTs, mostly NFTs that are essentially images. So the key question of this research is, how do we actually value an NFT? How do we understand what an NFT is worth? And this question is very important because, well, first of all, it's one of the first questions that people in the NFT industry are asking. People who collect NFTs want to know how to value their portfolio of NFTs. People who view the market from outside are wondering, how do I understand if one NFT is worth more than another NFT? And the dominant approach that has been attempted and is starting to gain popularity is people are using something like hedonic price regressions to understand these values. And what that means is we'll take the sale price of an NFT, we'll look at an NFT market, we'll look at all the sales in this market, all the sale prices, successful sales, and we'll regress these sale prices on the characteristics of the NFT, on its attributes. And based on that regression, we'll then be able to generate predictions of the expected sale price of different NFTs at different points in time for NFTs that maybe have never sold before, because they have the attributes of some other NFTs that have sold in the data. So using this type of an approach, this hedonic price approach is sort of the dominant one that is being adopted. But what we'll show in this research is that you actually have to take into account how these markets function. You have to take into account the selling mechanisms that are being used in these markets, whether it's an auction, a descending auction, a fixed price listing, and so on. And you also have to take into account information on sales that were not successful, on attempted sales that didn't work, in order to arrive at valuations that are more reasonable. And in this work, we illustrate by comparing these two approaches. If we use an approach that incorporates all of this information about the market to an approach which is based purely on hedonic price regressions, we end up with two biases, a selection bias and a mispricing bias. And I'll go more into what these biases are and how they can give us very different valuations for the same NFT. And then practically, we contribute as well by developing a decision support tool where you can input the ID of an NFT and it'll actually give you a valuation of that NFT. Now, I should also mention this question is very similar to the art world, the traditional art world, because in traditional art, we also have to value artworks in some way. But there are some key differences in the NFT market. Namely, in the NFT markets, we have actually higher quality data usually than we do in the traditional art world, because many of the transactions are logged on blockchains, which means that we see attempts to sell things. We see the mechanisms that people are using. We see the prices that they're setting. And we see finally the resulting sale prices. Whereas in the traditional art world, some of this data may be missing and not very well observable. And also what's important is that in the NFT world, if we're able to value NFTs, it's possible to create other applications that can use these valuations and do things with them. Like, for example, NFT lending protocols, NFT collateral protocols, and so on. So beyond the traditional art world, we can also make very cool applications if we can answer this question of how to value NFTs. All right, so moving now into the data. For this work, I'll be looking at a data set from CryptoKitties. And the reason why I'm looking at CryptoKitties is because, as I mentioned, we started this project almost a year and a half ago. And back then, CryptoKitties was actually the biggest and most relevant NFT market. So if I were to look at it today, I might look at a data set from CryptoPunks or maybe from Axie Infinity. But for this research, we're looking at CryptoKitties. And they do have some similarities and parallels to the big projects today, like Axie Infinity, for example. A CryptoKitty is an image of a cat, and you purchase the NFT, which is the digital certificate of ownership of this particular cat image. Here we have ID number 57, which sold for about $3,000 back in August 2019. And each CryptoKitty will have this discrete set of attributes which describe its appearance. So the good news for us is that if we want to entirely describe the appearance of a CryptoKitty, we actually have all of the information in the data based on the attributes that it has, which will describe its appearance entirely. So that limits some concerns about unobservable characteristics of the cats that we might not be able to capture. Here's a small descriptive picture which illustrates the market period that we're looking at. For this research, we're going to focus on a period that's relatively stable, where we don't have very crazy volatility in the exchange rates of the cryptocurrencies, and the market also appears relatively stable. The left plot here shows the number of transactions over time throughout the year 2019. The right one shows the daily mean sale price for CryptoKitties. And our reason for focusing on a stable market is that we really want to kind of understand in stable conditions what are some of the biases that emerge when you try to use traditional approaches to valuation. And in total, we'll focus on about 72,000 auctions. So CryptoKitties are sold using a descending price auction mechanism. And we have about 72,000 of those that we'll focus on in the data. And the total volume here was about $100,000 or so. So this is small compared to the volumes we see these days. But back then, this was a very significant project and actually quite a significant volume. Now, I should mention as well that Axie Infinity, which is currently the largest NFT project based on transaction volume, also uses a very similar type of selling mechanism. They also use descending auctions in combination with fixed price listings. So I think our results, even though they're focused on this market, can extend to these much larger markets as well. And in terms of the data, so there's one thing that we noticed when we looked at the data, and that thing is that sellers may not have a very good sense of how to actually price these assets. And that's going to feed into this mispricing bias that we identify when you try to use the resulting sale price data to get valuations. To see this graph shows descriptive statistics of the auction design. You have here starting prices of the auctions, ending prices of the auctions, and the price ranges of the starting to the ending price of the auction. And S means the auction was successful, U means that the auction was not successful. One thing to notice here is that participants tend to be setting extremely wide price ranges quite often. You can see here, for example, if you look at the second row for the unsuccessful auctions, the starting price here, the maximum starting price that someone tried to set was 1 × 10 to the power of 13 ETH, which is greater than the GDP of some countries, I think. So they were trying to sell their CryptoKitty for more than the GDP of a small country, which of course is very unlikely to actually result in a sale. And then you can also see that in terms of the lower prices, some people would set the ending prices of their auctions to be lower than 1 cent or almost 0 ETH, which is worth almost nothing. The average price, however, typically when these CryptoKitties do sell, they would sell for about $4 or $5 in our data set, maybe up to $10. And gas fees were not extremely large in that time period, these transaction fees, to really hinder these sales significantly. But we do see quite wide ranges that are being set by the sellers. You know, sellers are setting very, very wide price ranges. Another thing that we noticed when we looked into the data set is that it seems like there's some evidence that sellers overvalue or don't exactly capture buyer preferences very well. And we can see that here in this graph. This graph shows us what we observe in the data as well. If we look at items by their ID number, low ID numbers are typically considered to be more valuable and more rare, and so more expensive, whereas high ID numbers are not as attractive, they're not as interesting, so they tend to sell for lower. And when we look at the auctions that the sellers are organizing, we do see that they tend to set higher prices overall for the more rare items that should sell for more. And they do tend to set lower prices overall for the items that have high ID numbers that are kind of less unique, less rare. But what happens is that the sales for the low ID items, they tend to happen towards the end of the auctions, whereas for the high ID items, they tend to happen towards the start of the auctions. And if we were to compare this to an optimal descending auctions model, it's actually optimal to have set prices such that the sale would occur somewhere in the middle of the auction. You don't want to set the starting and ending prices such that people buy immediately or they buy extremely late towards the end when the price is at its lowest. And that is also some evidence that maybe sellers are not really pricing very well in this data set. And then of course, there's a lot of anecdotal evidence. If you look at the Reddit for CryptoKitties, if you look at the Discord, most of the people are asking questions about how to value their kitties. So there's a lot of evidence that sellers maybe don't really know how they're pricing, how to price optimally. So our solution is as following. We develop a structural econometric model, a stylized model of these descending auctions where we have 2 players. That's the minimum number of players that we need to really capture the incentives of these descending auctions. And these two players are going to sort of look at each auction, and they're going to make a decision of when to buy. And the way it'll work is as follows. The first player will always move first, and the second player always moves second. And the time period T is determined based on the duration of the auction. So suppose that this auction that I'm drawing here is a 3-period auction. The price is descending as I've drawn it on this graph. What happens in period 1 is that player 1 goes first and decides to buy or not. If she decides to buy, then the auction is over. She obtains the CryptoKitty and she has to pay the highest price. And that's it. If she decides not to buy, then player 2 gets to make a choice of whether or not she buys. And the same story repeats itself. If player 2 buys, the game ends. If she doesn't buy, then the game continues into the subsequent period. If she doesn't buy, well, then the price descends because this is a descending auction. And the same game repeats itself again in the following period. And then similarly, if they don't buy, the price again will descend and the game repeats itself. Now this structure, this way we capture 2 incentives that the buyers are facing. One is they have an incentive to wait, because if they wait, the price is going to be falling. But 2 is they also have an incentive to buy as soon as they can, because the other player might spin and purchase the item and it will just be gone. So those are the 2 main incentives that we capture with this model. Here is sort of the mathematical specification of this model. We have utility functions associated with buying and with waiting. And if you wait, then you're sort of, you have the expectation of the future periods of your expected maximum utility in the future periods. That will result from you waiting. And there's also this probability term here, theta, which is the probability that your competitor will just buy the item and you won't even have a chance to consider that future sort of expected value. So this is kind of a dynamic programming setup, a dynamic discrete choice setup that we're using to model the player's decisions. We fit this model to the data. We use data on actual purchases from these auctions to obtain the parameters of these models. And we find that we can fit the patterns in the data relatively well. We can explain the sale probability over time, as well as this little bump that happens where we see that people tend to be more likely to buy on the last periods of the auction. And just in general, we can also explain the probability of a successful sale as a function of the duration of the auction relatively well as well using this type of a model. Now, let's actually get to valuations now.
Yeah,
So
sorry, now you are starting to run out of time. So
sure. Do I get 1 minute?
You get 1 minute.
Okay, thanks. So we're going to be comparing 2 valuation approaches. One is using a hedonic machine learning model where we're predicting sale prices as a function of the characteristics of the item. And the other is using our structural modeling approach. And I'll sort of jump to the results. We identify mispricing bias, which is the fact that the hedonic regression approach undervalues NFTs by about 12.5%, because it doesn't take into account the factor that sellers may not be pricing optimally. So if we adjust for that, we actually arrive at prices that would imply higher valuations for the items. And the second point is because of the selection bias, the hedonic model does not consider sales that were not successful. It turns out that hedonic regressions actually value NFTs that did not sell higher than they do NFTs that did sell, whereas the structural model does the opposite. So this is another form of bias that results from selection. And here's a small demo of our tool that helps you arrive at reasonable NFT valuations using our model. So that's it. Just a brief conclusion, some implications. It could be very helpful to provide recommendation tools to people in these markets because they don't seem to know how to price well. It's important for the projects to store transactions on chain and also unsuccessful transactions as well, because this data is important for getting at valuations. And finally, interpret the numbers cautiously if people are giving you valuations that are based only on successful sales data. So that's it for me, and very happy to discuss more if anyone's interested. Thank you.
Yeah, thank you. So that was interesting. And now to a very different topic. So Andreas Park is gonna tell us what is wrong with constant product market making.
All right, thank you so much. Okay, all right, thanks so much. I figured you already want to see me in the middle of the screen, so this is why I try to tech up a little bit. So I'm going to talk to you about automated market maker models. In particular, the kind of questions that were asked is about how the pricing works. Now, so first, let me explain what we mean here. Automated market making is a new tool available on the blockchain, in particular on Ethereum, as a form of a decentralized exchange or a decentralized trading mechanism. So very broadly speaking, the way it works is that liquidity providers provide post or deposit pairs of tokens. So in this example here, for instance, DAI tokens and Ethereum tokens into a smart contract. And then liquidity demanders can send money or send a token to this contract, and there is an immediate atomic swap transaction in which the person then receives the other token in exchange back into their wallet. Now, there's the really key question for this is how would you set the price here? And taking a little bit of a step back, so I'm in the area called market microstructure in finance. And so the questions that we ask there are about trading systems. We ask questions about the institutions and then how these institutions affect market outcomes. And in many ways, the development in the blockchain, in particular, the decentralized exchanges, are really exciting for us because all of a sudden there's something new happening, something that we haven't seen before. Meaning here that essentially there is an attempt being made to establish a market using some form of hard coding of behavior and hard coding of pricing functions and so on and so forth. But there's also some other parts here that are really exciting, which is you use a piece of technology to pool liquidity sort of in an ongoing basis, which is really something that normally would like to see in markets, right? And in the markets that we normally study, we care a lot about liquidity supply, liquidity demand, and there's a large variety of different mechanisms out there in the world. And this one seems to be something which is particularly new, so this is really good for us. Now, the question that arises when you think about these market maker models or these automated market maker models is how do you set the price? So keeping in mind that this contract that we have here has to have some form of mechanism to establish what the person that sends money to this contract or token to this contract will receive in return. There's loosely two ways how you can think about it. One is an oracle. So you take information from other sources and therefore determine the price. And the other version that you would have for such a is to have a hard-coded pricing function. And what I will spend most of my time on is questions about hard-coded pricing functions. Very specifically, and so now when my thinking about this paper actually still develops. So you can think about it in two different ways when you try to approach this problem, right? You can say, what is, say, like in an axiomatic approach, what would be ideal features that we want to have for pricing function, and then what pricing function actually satisfies all these features. Now, it's actually quite difficult to do simply because, markets are complex, right? And it's difficult to determine what kind of behavior rules and assumptions you would have to make in order to represent axioms properly. So what I'm doing instead is something a little simpler, which is that I'm looking at existing pricing rules that we know that are well established, and I try to sort of provide some form of comparison. And in particular, I try to provide a comparison to the most standard pricing function that is used in markets is called constant product, which I come to in a second. All right, now, but if you think about things that you want to see in a market, generally speaking, what should that look like? Well, so you have a liquidity demand and liquidity supply part of the market. What you want is that liquidity demanders can trade in a sort of predictable way. There's no way how they can be exploited in some way. So if you decide to make a trade at a price which is sort of indicated to you, there shouldn't be too much of a deviation from it. I'm waving my hands. I'm going to be more explicit about that in a second. Now, also, if you look at the liquidity supplier part, you want to make sure that the liquidity suppliers get fair compensation for their risk. So if you think of there is a market for liquidity supply, there are, liquidity suppliers have a certain risk aversion, if you want, then what they receive from this hard-coded function should be something that is fair, right? Fair is obviously not something that is a well-defined economic terms, and I'm also going to be more explicit about that. Now, lastly, we have to keep in mind that this is a blockchain and that these particular exchanges operate on the mainnet of a blockchain. So that means that when you do a transaction or when you do an activity that is triggered by this exchange, it needs to be executed, or it needs to be the code has to be run that underlies it by every single node in the network. At least this is how the networks are currently set up. So what that means is that you really don't want to have a system set up in such a way that it invites whatever we call excessive trading. And I have to be more explicit about that too. So what I'm really meaning here is that if you want to make a trade, it should be, done as fast as possible in as little steps as possible, right? So These are is very loosely defined. I'm going to be obviously more precise in what I mean with this. But first, let me talk about constant product pricing or constant product automated market making. It is the standard way how most swap exchanges like Uniswap, SushiSwap, Balancer, how they all price their what the hard-coded pricing function that they use. Just for some background, I learned recently that such a rule was actually used around, I think about already 15, 20 years ago, I think for computer games and internal markets there. The idea is, I think there was a paper in computer science somewhere in 2012 about this, but mainly the main idea that basically triggered the usage of this in the Ethereum ecosystem in particular was by a Reddit post from Vitalik Buterin. And he basically proposed this pricing mechanism, and somebody else went out and was a little bit more elaborate and described it in more detail how it works. Now, the beauty of this mechanism is it operates solely based on the information and on the content of the contract that contains the tokens as a liquidity contract, meaning that it requires knowledge of the balance of asset A and asset B. And the product of these two at any given point in time provides sort of like an invariance factor, or as economists would call it, sort of like an iso-liquidity curve, so a curve of same liquidity. Now, the way the contract works is if you send a certain amount X to the contract, so you sell token X, you receive a token Y in return, and it is implied in such a way that the product of the quantities that are in the contract after the trade, so you add tokens X to the contract for the A token, and then you receive tokens, the other token in return, the product of these two has to be constant, which means that you basically trade along this curve here. Now, there's a lot of beauty to this. It's a very simple and intuitive way to program this in particular, because everything is already there in the contract. But as an economist, there are some issues that I have with this, or that one should think about, which is this is very ad hoc, right? And there's a question of if this actually A, invites some form of exploitation of liquidity demanders, and B, if this is adequate risk compensation for liquidity providers, right? So let's start with the exploits, because that's actually quite real. So the main problem is it invites so-called what people in the blockchain world call sandwich trades. As an economist or someone in finance, we refer to that as front running. So the way it works essentially is that, so what front running means essentially is you see a trade that somebody wants to do. What you do instead is you do the same trade of that person. You wait until the other person has made their trade, and then you sell back to the contract. Now, if this is something that you can do profitably, then you have profitable front running, and then you have also what's referred to as a profitable sandwich trade. And it turns out to be that given the particular pricing function, I'm not going to go into detail what that is, but this is an intrinsic feature of constant product pricing. Now, I'm not the first one to notice that actually Vitalik Buterin actually noticed that very early on, that is actually an issue. But the point I'm trying to make is we basically use a hard-coded function which invites this type of behavior. Now you ask, well, why does that matter, right? So you may have this function available, but you need to be able to do this. And is this really a problem? And the answer is yes, because it is actually intrinsically possible given the structure of how most blockchains work, in the sense of that you make a trade, you sign the transactions, it gets sort of, if you want, it gets cleared in the terms of finance, but it's not yet settled. So it's not been included in the block. And so once it enters the mempool, the miner essentially makes a decision of which order the transaction occur in a block. And since the information or the price of the item is determined by what is in the contract at the time when the transaction happens, it's possible that as the transactions within a block execute, that the quantities change, and therefore the price would change at which somebody would be trading. Now, what somebody can do who has access to the mempool, and they're usually publicly visible, in particular the miner, is they can insert themselves to do exactly this front running or sandwich transaction, which you see here behind me. Here basically, this transaction here in black is the transaction that the person wants to make, and the sandwich transaction is the one where, say, the miner makes a trade in one direction and then reverses their trade in the other direction. So in other words, it's an intrinsic feature of the organization of the blockchain that this front running is possible. Is this a real problem? Yes, it is. There's such a thing called miner or maximum extractable value. There's an entire project that deals with this. And just to give you the picture here, this gives you, there's at the moment, I think about $500 million worth of money people have been able to extract in some form in this kinds of exploits. And you can see from this pie graph here that most of this minor extractable value actually is attributed to Uniswap, SushiSwap, and Balancer. So essentially the type of trading venues that use these constant product functions. So that's a problem, I think, right? And so the next question is the one about the risk compensation for liquidity providers. So now I'm an economist, and I would like to think that, we think of markets. In markets, liquidity providers make an offer, if you want, of what liquidity wants to supply, and then they should be receiving something in return. Liquidity providers in some form compete. So there's a question, how can we express in some way whether or not there's fair risk compensation? But for that, we need a model. And what I did is I tried to take one of the most standard approaches that we have for expected utility, so decisions under uncertainty, which is I use the CARA utility, CARA normal framework, which means it's a function which is constant absolute risk aversion, which is nice here because we don't have to worry about the initial wealth of a liquidity supplier. And there's a particular utility function behind that, which gives us nice closed form solutions in terms of how we can assess the expected utility, right? So in fact, it's essentially a mean variance utility as we can express it. So now so the way this normally works is that the liquidity provider would therefore maximize the utility of their terminal wealth, and their terminal wealth will depend on the cash flow that they receive from the trade, the value of their risky position that they have before the trade, and after the trade, and the value of the inventory that they started with. Okay, and now this cash flow here, this is basically where the hard-coded pricing function comes in. We have a natural way to do this in economics, which is normally we think of it as sort of like we think of like in microstructure we call this uniform pricing. Every unit costs the same. You trade X. There's a price function. You pay the marginal price X, and the product of the two gives us the cash flow that you have to pay, or the price that the cost of a position. But there's other views that we have too. One is discriminatory pricing, for instance, where you pay the integral under a pricing form. So these are actually the most standard ones that we have. The latter one is sort of reminiscent in some form of limit order markets, which is how most stock exchanges operated. Now, in the paper, I try to make a comparison as much as I can between how constant product pricing would interact with a model where I either use the uniform pricing or the discriminatory pricing. And so for instance, here, this is for comparison of discriminatory pricing and uniform and constant product pricing. And you can see that there's a range of parameter values for which the risk compensation is actually too high. Now, there's also one where the risk compensation is sort of too low, where relative to what a market model would do, and the model that I present, I would think of as a market model. So the basic bottom, and so it becomes essentially an empirical question, which case are we living in? But the point I'm trying to make, the bigger point is, it's actually really difficult to reconcile this constant product trade market pricing with what would come out in a market in the way, at least, where people maximize utility and we can measure in some form risk compensation. Now, then there's a question of excessive trading. Very briefly, there's multiple approaches that I have in the paper. One simple way to think about it is it beneficial for me to split my order, right? So instead of trading, I want to trade an order of 2x. Is it better to trade x twice, or should I trade it in one go? Now here, constant product pricing is actually quite good because it's invariant to this. Now let me quickly compare the different prices in markets. And so for people who have seen my paper before, I should just make an admission here that thanks to a very thorough review, I actually realized that there was an error in some earlier version of what I did, which actually yields some even more interesting insights. And so here's just a comparison here. So profitable sandwich trading is possible under constant product pricing. It's difficult to have fair risk compensation for liquidity providers. And however, it's true that order splitting, for instance, is not profitable. If I take the uniform pricing approach, then sandwich trades are not profitable. Risk compensation by design is fair, but actually the splitting of orders becomes profitable. So, that actually is not an ideal solution either in that sense. And if I look at discriminatory pricing, and so this is where I make my error, is actually sandwich trades actually are profitable too, which may be explaining why regulators are so keen on prohibiting front running. compensation for liquidity providers is obviously fair by definition, and order splitting is also covered. So now the question is here really, if you think about if you wanted to impose or use one of the traditional models for a pricing model, which one do you care more about, excessive trading or sandwich trades? You know, becomes a design question. What I'm trying to say here, though, is there is no easy answer to this, which is interesting by itself. Okay, I'm almost out of time. Just you know, there are some remedies you can think about how you can protect yourself with this. I've done a little bit of data calibration exercise just to get a sense of the overcompensation that liquidity providers obtain and how much you would implicitly have to pay in order to protect yourself from front running. I use this for a very tiny data set, but just to get a sense of what's happening. I looked at trades of wrapped Bitcoin on Uniswap, and the excess costs essentially imposed on this trades are on the order of 53 basis points, which is quite substantial if you think of the prices in normal markets. So let me quickly conclude. So the big picture item here is constant product pricing actually does have quite significant issues in some form. And there will be an interesting question in the future if you actually had competing trading and pricing systems of how they would interact. So that's an interesting empirical IO question, which hopefully will transpire at some point. Designing an automated pricing function is hard. I'm currently trying to work with a project to actually, get a new type of pricing mechanism implemented, but doing it the right way is pretty hard. But we need to be aware of the specific features of the blockchain if you actually want to implement these contracts and these pricing rules. My view is, as an economist, I like to think that there's merit to thinking about it as an economist because there's some advantages to, say, the linear marginal pricing that we normally use. Okay, that's it. Thank you.
Thank you. So we are continuing on the topic of constant price market making, and the last paper is by Junna Oyagi, which is on coexistence of exchange platforms.
Okay. I hope you guys see my screen. Is it working? Okay. Okay. So thanks for having me here. I'm Jun at HKUST, and this is a joint work with my previous colleague at UC Berkeley. Yuki is he's here. And so this is a theoretical study on automated market makers and decentralized exchange platforms that previous presentation Anders mentioned. So basically if you want to trade crypto asset, you might be using the centralized exchange platforms like Binance, Bittrex, Kraken with many kind of famous.
Sorry to interrupt you. I don't know whether it's a case for us as well, but we hear your voice with an echo.
Oh, really?
I'm not sure whether you can do anything, but I mean.
Let me see. My sound. Okay. Okay. All right. So yeah. So traditionally, you're going to be using a centralized exchanges where kind of almost everything is managed and controlled by sort of the single centralized authority, which is exchange platform. But in contrast, like last summer, DeFi summer 2020, many exchange platform has been built on the smart contracts on Ethereum blockchain, or maybe some other blockchain like Binance Smart Chain. And of course, we have several categories of decentralized exchanges depending on what aspect is decentralized. But in this paper, we focus on most kind of decentralized exchanges like Uniswap, SwissSwap, PancakeSwap. So those kind of on-chain exchange platforms, it's very decentralized. So except for this infrastructure development, almost everything is decentralized and managed on-chain. And so the difference between centralized exchange and decentralized exchange, of course, it depends on what you're looking at and what is decentralized. But since this is a finance paper, we focus on the trading environment and also the asset pricing, algorithm. So in a traditional centralized exchange, we typically use this limit order, books or limit order structure. So for example, like if you go to Binance, you're going to see this kind of screen, which is a limit order book. So you have a bunch of limit orders proposing a trading opportunities, with some trading quantity and also ask and bid prices. And you can trade, by sending market order. So you're going to be matched with, some limit orders at the best price, and trade is executed at the proposed price. But this kind of limit order book is kind of, it both sort of the very complicated matching algorithm. And also you have to refresh this kind of limit orders in a continuous manner. So it's not really feasible on a blockchain. If you want to, conduct this kind of limit order book on the blockchain, you have to, it's going to be time consuming, and you have to pay kind of huge, kind of mining fees. So it's not really feasible. And instead of using this kind of limit order books, many decentralized exchange platforms are using these automated market makers. Okay. And as Andreas mentioned, this is sort of the new market making structure. You can think of it as a pricing algorithm, which is very simple, and determine the price for the trade as a function of the a trading volume and how much liquidity the decentralized exchange already have. It's kind of very simple but new market making structure. And these kind of automated market makers are, they're playing very, very important role in a prosperity of decentralized exchanges. So, for example, this figure shows the trading volume on the decentralized exchanges, and apparently it's growing very rapidly, and mostly driven by the decentralized exchanges with automated market makers. Okay, so now they have kind of large trading volumes. But at the same time, we also know that centralized exchanges with traditional limit order book still handle kind of huge trading volume. So inevitably, we are in a situation where this kind of new market making structure, AMM, and the traditional centralized exchange with limit order book, they coexist. Okay, so we want to know what's going to happen if this new one and old one coexist. And to analyze that, we provide a theoretical framework to describe this kind of situation. Okay. And because this is a finance paper, we introduce asymmetric information problem between traders. So some traders know some material insider information about the uncertain fundamentals, maybe return of the asset, while other traders don't know. And also I endogenize the trader's choice of trading platform. And when I say trader, of course, it includes the liquidity providers. So liquidity on both exchange platforms, AMM and limit order book, they're going to be endogenously and jointly determined in the agreement. Okay. So I guess the kind of one of the biggest contribution of this paper is, providing theoretical framework and, pin down the kind of analytical solution for the general equilibrium problem. All right, so here is a summary of the kind of main findings. So we want to know how liquidity on a decentralized exchange is determined and how it affects the traditional limit order liquidity. And also we want to know how traders will, decide on the trading venue. And so first of all, we find that asymmetric information problem is going to negatively affect the liquidity on a decentralized exchange platforms. So actually, we know that traditional limit order book market asymmetric information negatively affect the liquidity. And this paper shows that even though automated market is different from limit order book, the implication of informational friction stays the same. And also, we find that traders' choice of the trading platform depends crucially on the informational background. And also, liquidity on a decentralized exchange, it has sort of the positive spillover effect on the liquidity on the limit order market. So they complement each other. And then we solve for the general equilibrium and conduct some comparative statistics where we can provide some asset pricing implications, and we also analyze some other market quality variables. Okay, so this is what we find in a paper. So here is the brief, very, very brief description of the model, just just to share what we have in our mind. So in a paper, we think about the one-shot trading game of the risky asset, whose return is stochastic and not observable. And before the trading game starts, market maker is going to provide liquidity both on the centralized limit order market and the decentralized automated market. And then trader liquidity takers, they're going to arrive at the market and make transactions. And there are two possibilities, mutually exclusive. So first of all, it is possible that this kind of return fluctuate. It's going to explain some innovation, but this is not observable person. But in the economy, there are some traders who know some insider information about the realized value of the asset fluctuations. So those guys are informed traders, and depending on the speed that goes up or go down, they're going to be buying or selling the asset in order to make some positive profit. And at the same time, with a complementary probability, this asset return will not fluctuate, but there are some traders who want to be buying and selling randomly because of some exogenous trading reasons. So those guys are, we call noise traders in the finance literature. So sort of the exogenous traders whose trading behavior is independent of the asset returns or maybe the profit. So it's something like the trading because of the, for example, like a margin constraints or hedging motifs or immediate borrowing or lending requirements. And in a paper, we assume that those noise traders have to take some position in a, for example, stable coins or maybe assets as soon as possible because of, for example, like margin constraints. So in other words, they face sort of the needs for immediacy, and we give them sort of the heterogeneous preference for delay on a decentralized exchange because, if you want to trade on a decentralized exchange, it takes a little bit longer time compared to the centralized exchange because you have to go through the, minor verification process. So they have heterogeneous preference for decentralized exchange, but it's not really essential. I mean, this is just to pin down the equilibrium in a model. So we can also think about the, for example, like security concern in a centralized exchange, or maybe some traders don't want to go through very troublesome, kind of know your customer verification process on a centralized exchange. But I guess those kind of difference between CX and DX, any kind of characteristic will be accommodated. And then after the trade, information about the return becomes public, where market makers can reprice their limit order and withdraw liquidity from the decentralized exchange. Okay, so this is what's going on in a model. Okay, on a centralized exchange with limit order book. So first of all, market maker is gonna submit limit orders by specifying bid and ask prices. So for example, like bid price is the price at which this guy is willing to buy the asset. And following the finance literature, liquidity in this case is measured by the bid-ask spread, okay, or maybe the trading cost for liquidity takers. Because if I buy one unit and then sell that asset, my position doesn't change, but I have to pay this difference between bid and ask, so it's kind of trading cost. And I have to pay this bid-ask spread, I mean the positive bid-ask spread, because of the asymmetric information problem. So of course, in a real financial market, we have some other frictions, but here we focus on the information friction. So suppose that I'm a market maker and submit limit order. I don't know who will take this limit order. So if informed trader takes this limit order, I will lose some money because informed trader is going to take my liquidity if and only if that is profitable. And the fact that this informed guy is making positive profit implies that I'm losing some money because trade is basically zero-sum game. So in order to compensate for this kind of cost, I will charge higher ask price and lower bid price. So the bid-ask spread gets wider. So basically, bid and ask prices will be a function of the how many, for example, informed traders are buying and how many noise traders are buying. And for example, like ask price is going to be an increasing function of the informed trading and decreasing function of the noise trading. Okay? So the bid-ask spread or liquidity on a centralized limit order market will be determined by the information asymmetry. On the automated market, so the market maker is going to inject traded assets, as well as corresponding value of maybe cash or stable coin into the liquidity pools. And then, they're going to do so in expectation that some trade will happen and it's going to change the size of the liquidity pools. It's going to be positive and negative. And of course, in the real financial market, we have some rewards, but we're going to abstract away from this kind of exogenous reward and focus on this endogenous change in the liquidity pool. Right. And trade will happen, and the price is determined by the constant function market makers, okay, specified by some function f. So in a paper, we are going to deal with this kind of very general function. We are not going to provide the kind of specific functional form for this kind of f in order to make the generality, keep the generality. And for example, like if f is just a product, it reduces the case with constant product market makers as in the case of Andreas' paper. And what is important here is the price is derived by this kind of equation, which is the function of the trading size delta and the amount of liquidity provided by the market makers. And this price is an increasing function and a convex function of the trading size, and the marginal price impact is decreasing function of this x liquidity. Okay, so now I'm going to skip this constant product market maker because Andreas explained detail. So here is the visualized description of the model equilibrium. So as I said, the market maker is going to provide liquidity by specifying bid and ask prices, as well as by providing this X liquidity on a decentralized exchange. And given that, informed traders and noise traders, they're going to be differentiated between these two platforms. For example, like a beta fraction informed trader is going to be trading on a limit order market, while 1 minus beta fraction will be trading on a decentralized exchange. And same is true for noise traders. And we know that those ask and bid prices, they're going to be a function of how many informed traders are there and how many noise traders are there. And the same is true for DX marginal price. But DX marginal price also depends on this X, liquidity on the DX, okay? And maybe in 1 or 2 pages, I will show this X also depends on informed trader and noise traders measure. But because I want to take backward step in the backward induction, let me take this X as given first. Right, then given this X, informed traders going to choose their trading platform so that the marginal trading cost on both two exchange platforms is going to be the same. And also noise traders also care about the heterogeneity like us. Right, so first of all, given this X, we can analyze traders differentiation and the liquidity spillover effect. So if you're an informed trader, you tend to cluster on the same side of the market because informed traders are trading based on the same information. And that is going to generate sort of the large shift in the liquidity pools, meaning that they tend to incur sort of the large price impact on a DX. But this is not true for noise traders because even if you got sort of the margin call, you cannot expect other traders' behavior because they are random and independent. So you expect that random buy and random sell order tends to cancel out on a DX, and you expect the limited price impact. So the limited price impact on noise for noise traders and the relatively large price impact for informed trader, they're going to generate sort of the disproportional reaction of the informed traders. So for example, like suppose a DX liquidity goes up and the marginal price impact declines on a DX. Then, informed traders are very happy about it because, they can enjoy this kind of reduction in the price impact a lot compared to the noise traders. They don't care about the, price impact because they face limited price impact to begin with. Then, this implies that more informed traders are willing to migrate away from centralized exchange to the decentralized exchange compared to noise traders. And CX now has relatively small number of informed traders, and meaning that, market makers on the centralized exchange, face a, mitigated asymmetric information problem. So the bid-ask spread shrinks and the market liquidity improves on a ring dollar centralized exchange, okay? So because the opposite direction argument is also true, we can say that DX and CX will complement each other in terms of liquidity, okay? Right, so now we want to endogenize DX liquidity. And in order to do so, we have to formulate the expected return for market makers on a DX. So on a decentralized exchange, informed trading is going to generate impermanent loss, meaning that, because informed traders are always withdrawing kind of more variable asset by adding less variable asset. So if informed trading happens, the variable liquidity pools decline and market maker lose money. While if noise trading happen, it is random trading with convex pricing. And because of Jensen's inequality, we can say that the post-trade liquidity pool size will go up. Okay, so if you're in share here and random trading happens, Jensen's inequality implies that post-trade expected value should be high. So the profit for the liquidity provider is it consists of the informed trading cost and noise trading profit. And then by solving that, we can pin down the equilibrium, amount of liquidity on a decentralized exchange as a function of informed trading and noise trading. And then, combining with this, informed and noise traders behavior, which depends on the X, we can, solve for the fixed point problem. Okay? And we have kind of unique stable equilibrium. Right, so this is general equilibrium. And we conduct several comparative statistics, and in the paper we have several results, but let me pick just 2 interesting results. So basically it comes from the convex pricing of the automated market makers. So this convex pricing implies that buying 1 unit of asset generates larger price impact compared to the selling 1 unit. So the price impact is asymmetric between buying and selling. And if you combine this fact with the informed traders reacting more than noise traders, you can say that informed buy order or informed buyers, they actually exhibit kind of strongest reaction to the exogenous variations. For example, like if DX becomes less attractive due to some exogenous shock, then informed buyers are more likely to migrate away from DX compared to the informed sellers. So the sell order on a DX is more likely to be followed by, it's going to be more informative compared to the DX buy order. Okay? So asymmetric informativeness of the sell and buy order DX. What's happening on a CX? So, this asymmetric price impact on automated market.
I think, Satya, if you could try to approach the conclusion, it will be great.
Yeah. So, asymmetric price impact on a automated marketing price set, it should be true also on a centralized exchange. So this implies that bid and ask price should be distributed asymmetrically distributed around the expected value of the asset. So midpoint is going to be, biased compared to the expected value of the asset. So it no longer works as the proxy for the market efficient expectation. Okay. So this kind of asset pricing implications, or maybe the testable implications. So here's the conclusion. So, the decentralized exchanges, they adapted, implemented kind of new market making structure, AMMs, and, they coexist with the traditional centralized limit order book markets. So we provide a theoretical framework to analyze such a situation with asymmetric information and endogenous traders venue choice and endogenous liquidity on both exchange platforms, and find a liquidity relationship between these two platforms, and also derive some implications for asset pricing and informativeness of the order flows. Okay, so that's it. Thanks for listening.
Okay, thank you, and thank you all presenters. I think it's a time for an applause. I'm sure everybody is joining. And yeah, if it is still okay, it is also a good time perhaps to have some questions. So.
And there were some questions in the chat, so maybe people who ask questions in the chat can just unmute themselves and ask them now.
Yeah, well, I will, in the meantime, perhaps jump in with a couple. So maybe one for the two last presentations on the constant product market making. In both cases, there is a specific degree of market impact built into this constant pricing rule. So that that if I'm buying more, I need to pay more, which perhaps could be designed differently, because in other markets we also know that market impact is something which makes it difficult for information to get into prices, as well as creates order splitting. So it would be nice to, if you both share your views on this aspect.
I'm not 100% sure, but so I think if I may say something, right? So the constant product function has some nice features, right? It's one of the ones that people really appreciate is the liquidity in the contract can never be depleted by an order, so that's in some sense it's useful, right? Whereas in the framework that any other framework that we have, we're making essentially an assumption that somebody is willing to put an amount of cash in. And so there is really no provision of how we think about this relatively to these constant product functions, right? Now, if I may say, so I think a bigger question, a general question also that Arun had was, or that Yoon had was, this is not so much of a new question in some sense. I mean, in particular, I like its analysis a lot. There's actually work already out there also on the comparison of limit order markets and dealer markets. There's a lot of work on that. There's a paper by reconciling, for instance, Glosson and Milgram and the limit order market, right? Kyle meets Glosson and Milgram, so to speak, right? So there's actually, looking at the competition of markets, looking at the competition of different frameworks is a hard problem. And a lot has to go into it to think about it. So for instance, Jun's paper and mine differ in the sense of that I look at simply a model without asymmetric information. There's still risk, but there's asymmetric information. He looks at a model which has essentially risk neutral for liquidity providers, but asymmetric information. Putting both of them together is conceptually hard. And so that means it's difficult to actually, if you wanted to even build an automated market maker which accounts for all of this, this is a really difficult problem. And the simplicity of a contract is a really important feature in these markets. So if you, for instance, take a Kyle model, is quite complex, requires lots of updating. It's not clear that you can actually write a contract that will be doing that, right? Theoretically, you can probably do it, but practically it's not feasible and got to be too expensive. So the interesting part for all of us is that there's these heuristics and we have to understand how they work together, right? So.
Great. Thank you. So maybe also something to Pavel, perhaps a bit provocatively, your findings that in this market, you can't go very far. I mean, it doesn't the hedonic pricing regressions don't price things well, but like, do you think that the same biases would be also present in the physical art market, in the sense that normally there is less data in these circumstances, and the same biases may be present, but maybe not, because you have this slightly different object, which is not as unique. So what's your thoughts on that?
Yeah, thank you for your question. I think there are lots of parallels between the NFT market and the traditional art market. I think these biases are definitely present in the art market as well. If we use only successful sales of art from Sotheby's to value art, we're missing all of the transactions that happen person to person that we don't really have data on. We also miss data on transactions that were attempted but were not successful. I think another difference, though, between these two markets is that art markets have been around for a longer time. So there's more opportunity to learn about what are the reasonable prices for different things. Whereas comparing to NFT markets, which have just kind of emerged, there's more space for sellers to be making mistakes or to sort of be kind of learning and trying to figure out what the best prices are. So for that reason, I think it couldn't come too soon to have solutions that actually kind of help identify, the relevant prices for these items.
Okay, thank you. And Ganesh, also one question to you. So you are looking at interesting aspects about the speculators and arbitrageurs incentives, while I suppose that some motivation of creating DAI would be people using it for borrowing, which is something that you don't look in your market. But I was wondering whether you are having more thoughts about the interaction of the extra frictions arbitrageurs or benefits bring for the ones that actually would want to use this tool for borrowing money, let's say for some investment or something like that.
Yeah, so we are a bit agnostic about other uses for DAI. So we have kind of this exogenous demand shock, and that could be, extended to think about safe reasons for safety, so sometimes in periods in these risk-off events, you have a safety premium on stable coins. So that's kind of an alternative hypothesis to the channel we put forward, which is kind of investors leveraging and deleveraging when ETH returns go up or down. But yeah, I mean, I agree that in practice it can be used for many different applications, but we were a little bit simple in terms of what the demand side for DAI is.
Okay, so thank you. So I guess that there are last chances to ask questions by the audience in them.
Has a question? Hi, I have a question to Andreas. So I'm just actually wondering, is it actually true that the front running the mempool is not really actually issue specific to the automated market maker? I mean, as long as actually people can see your buying trade and think it might be informative, no matter it's actually through automated market maker or some other mechanism, there still be actually front running, right? So is that true, or is there something that is sort of specific to automated market making that actually making it worse? Yeah, thanks.
No, it's a very good question. So so let me give you, let me get two-part answer. So as long as there's a public mempool and there's a time difference between an order being cleared, if you want, and settled, and the settlement price of the order, depending on whatever is in the contract at the time, then you will have the possibility of front running. And so this is kind of intrinsic to the particular setup. It could that could actually hold for any number of other markets. So the whole big background on this minor extractable value is always the problem that somebody could submit some form of profitable transaction that can be observed by a third party. We see this also in liquidation of vaults, for instance, where that is a possible problem. There's a really cool article online, or it's called Ethereum is a Dark Forest, where a different case for a different transaction is being described. Now there are, and this is the second part of my answer, there are some projects where you try to actually shield some information away from, general mempools. You can think of mempools where you have some form of agreement with a group of miners such that they wouldn't engage in front running, because ultimately this front running is, or the sandwich trades is something that you have to code into your code, right, into your transaction ordering. But I'm not sure where they actually stand there. And then there's some techniques that people try to use, sort of like zero knowledge tools in order to prevent, profitable trades to be visible in the mempool. But that's really quite complex. I'm not sure where the technology stands on that. The point that I try to make is, if you design a pricing function, you may just as well keep that into account. And so unless we think that the constant product function has such significant advantages that we can't do it differently, then maybe it's worth thinking about a different model there.
Yeah, thanks.
Okay, thank you. So I guess it's a time for more applause.